You've probably noticed it. Markets swinging wildly, gold prices soaring to record highs, and policymakers around the world scrambling to explain what's happening. Europe's auto industry is in shock, US markets are on a roller coaster, and China seems to be playing chess while everyone else is playing checkers. But here's the thing. These aren't isolated events. They're all connected, like falling dominoes. And the deeper you look, the more it feels like the world economy is being run on impulse, not intelligence. Leaders act first, think later, and the fallout is reshaping the global financial order in real time. Before we dive in, if you find value in understanding the global economy from a bigger picture view, not just the headlines, make sure to like this video and share it with someone who follows markets. It helps a lot in getting these stories out to more people who care about what's really going on behind the scenes. Now, let's start with Europe, because what's happening there could be the spark for a much larger fire. Recently, the Netherlands made a bold, and some say reckless, move. They expropriated Nexperia, a semiconductor firm owned by China's Wingtech since 2018. The Dutch government said it was acting on national security grounds, worried the US might blacklist the company under its new export control rules targeting Chinese tech ownership. But in trying to stay aligned with Washington, the Netherlands may have just set off an economic time bomb in Europe. Why? Because in response, China quietly pulled the plug on exports of certain finished components, including the 6 billion chips Nexperia produces every month. They aren't the latest high-end chips, but they're absolutely essential, used in vehicle control systems and industrial electronics. Without them, production lines stop. And that's exactly what's now threatening Europe's auto industry, the very backbone of the EU economy. We're talking about an industry that makes up over 8% of Europe's GDP and employs nearly 14 million people. The European Automobile Manufacturers Association, which includes giants like BMW, Mercedes, and Toyota, has already sounded the alarm. If the chip flow doesn't resume soon, car production could grind to a halt. Behind the scenes, court documents now show that the Dutch move was heavily influenced by US pressure. Washington's rules now extend export restrictions to subsidiaries of banned entities, meaning Nexperia was a ticking time bomb from the moment it stayed under Chinese ownership. But the backlash from Beijing was swift and symbolic. Chinese state media called the Dutch decision 21st century piracy, comparing it to the colonial era when Dutch ships seized resources from Asia. Within days, the Dutch minister was back in Beijing, looking for a way out of the crisis. It's a perfect example of how economic nationalism can backfire in an interconnected world. One country acts out of fear, another retaliates, and suddenly millions of jobs and billions of euros are on the line. Meanwhile, across the Atlantic, the US is dealing with chaos of its own, but of a very different kind. In just the past few trading days, the S&P 500 has whipsawed back and forth, not because of fundamentals, but because of tweets and policy outbursts from former President Trump. On Friday, Trump announced a 100% tariff on Chinese goods. Markets tanked. Then he walked it back, only to go on television again, accusing China of economic hostility for not buying American soybeans, and even threatening to ban exports of US cooking oil, a statement that immediately turned into a meme storm online. Investors are used to volatility, but not this kind of political theater. When the White House becomes a source of market panic, it erodes the very confidence that drives investment. Now, Trump's defenders say it's all part of his art of the deal approach, projecting strength to force China's hand. He's repeatedly said that Beijing only respects toughness, but even he admitted during a Fox interview that 100% tariffs aren't sustainable, that they could stand potentially, but not long-term. Still, his back and forth has left the markets dazed, with Wall Street becoming the real enforcer of discipline. When stocks plunge, policies suddenly change. When they rebound, the rhetoric returns. That's not economic strategy, that's improvisation. And yet, in a strange twist, Trump has also praised Xi Jinping, calling his life story amazing and hinting at another possible meeting. The oscillation between confrontation and admiration sums up the inconsistency at the heart of US-China relations today. But while the West is tangled in its own contradictions, the rest of the world is moving on. Central banks from Asia to the Middle East are quietly making one of the biggest shifts in decades, buying gold like never before. In just the past 2 years, gold prices have doubled, now trading above $4,000 an ounce. But this isn't about speculation, it's about protection. Central banks are moving away from the dollar, fearing political risk and currency weaponization. According to Deutsche Bank's Michael Zhu, gold now makes up roughly 30% of global reserves, up from 24% just a few months ago. Meanwhile, the dollar's share has slipped from 43% to 40%. For context, back in 2000, that number was over 70%. That's an enormous shift and a warning sign. Gold's rise isn't just about price, it's about trust. Central banks are effectively saying, we don't trust politics, we trust physics. Gold can't be sanctioned, frozen, or inflated away. This flight to gold mirrors what happened in the 1970s, when the US lost credibility during the Vietnam War and the stagflation era. Back then, trust eroded, inflation soared, and investors ran to hard assets. The same thing is happening again, just on a global scale. By the way, if you're following this far, I'd love to know your take. Do you think this massive shift toward gold is temporary, will begin, or is it the start of a new monetary era? Drop your thoughts in the comments below. I read every one of them, and they really add depth to the discussion. Now, stepping back, let's talk about the bigger picture. These events, from the Dutch chip crisis to US tariff chaos to the gold surge, are all part of a broader trend we've been tracking: de-dollarization and the rise of a multipolar financial world. For years, the US dollar has been the center of global finance, a symbol of stability and trust. But when sanctions become a routine tool and policy decisions swing wildly from one administration to another, other nations start asking, is this system safe for us? And that's where China's strategy becomes interesting. Unlike the West, Beijing has mostly stayed silent and patient. While others burn political capital, China strengthens its trade networks, invests in commodities, and quietly accumulates gold. They're not rushing. They're waiting for others to overplay their hand. In many ways, that's exactly what's happening. Europe's move against Nexperia, America's tariff chaos, these are unforced errors that push the rest of the world to seek alternatives. But let's be clear, the flight from the dollar isn't inevitable. It's a reaction. If the US and Europe return to predictable rules-based policies, global confidence in the dollar could be restored. But unpredictability and unilateral actions, those only accelerate the shift away. We've seen how quickly credibility can erode, and how hard it is to rebuild. The Dutch government thought it was protecting its national interests. Instead, it triggered a supply chain crisis. The US thought it was pressuring China. Instead, it pressured its own markets. And now, central banks are responding not with words, but with tons of gold. Markets have a way of correcting political mistakes. They reward credibility, and they punish noise. And as gold continues to rise, it's sending a clear message. Stability is scarce, and it's valuable. Looking ahead, the question isn't just what happens to gold or the dollar, it's whether the world can return to thoughtful, strategic policymaking. Because what we've seen lately is the cost of acting without thinking. Every reaction creates a ripple. Every decision triggers another. China's patience, Europe's missteps, America's unpredictability, they're all shaping the next phase of the global economy. A world where trust, not dominance, decides who leads. So, as we wrap up, remember this: markets have long memories. Political blunders fade, but economic consequences linger. From tulips to tariffs to treasuries, history keeps repeating the same lesson. Act rashly and the market will teach you patience. If you found this breakdown insightful, make sure to like this video, subscribe, and ring the notification bell. It really helps the channel grow and keeps you updated on stories that mainstream outlets rarely explain in full. Thanks for watching, and until next time, stay informed, stay curious, and see you in the next one.